G'day folks, it's Jim here from Orchard Forex. Given how we're all locked up at home these days, I thought I'd do a quick video with a technical outlook for the coming week, but concentrating mostly on the stock markets and commodities rather than on FX, which have been choppy. There are some trading possibilities out there which we'll go through, but essentially the currency charts look rather indecisive, so I think there are better places to look for trades right now. Having said that, we do have central bank interest rate decisions to come this week from the BOJ, from the Fed and from the ECB. So we could actually see some decent action later in the week. Given that no new policies are expected at these upcoming meetings, following the recent huge injection of liquidity globally, the greater focus seems to be likely on the preliminary readings of the first quarter GDP, which will come from Wednesday with regards to the US market, and then from the EU, the ECB released their preliminary numbers on Thursday. So ahead of that, let's go and have a look at the charts, beginning with the S&P. Okay, here we have a daily S&P chart. Now, as you know, we've had a decent rally off the base of from April's low, and the question now is, are we in a V-shaped recovery, or are we going to fade here and head back towards the lows? My own view right now, we need to be pretty nimble on this, but right now we closed on a positive note on Friday, and the daily charts, we've had a decent run up from the oversold situation over the last couple of weeks, but the dailies do look as though they're pointing a little bit higher. I wouldn't get too married to that, but more encouragingly, the weekly charts, which do remain oversold, they are turning higher as well. Now, we finished the week right on the 100-week moving average for the S&P. I think as long as we don't go back below the 200-week, which is at 26.50, that's best end of 200 points away. But as long as we stay above there, I kind of think we can make further progress to the top side. Now, where the resistance, if that's going to be the case, the 61.8% FIBO level is sort of 29.25 on the S&P. And if we can get through there, then we're heading back up to this sort of above 3,000, which will be a fairly amazing situation. For the time being, I mean, that still seems to me quite some way off, but it's certainly the direction I think we're probably headed in. So overall, I would be buying dips, possibly back down to here, this sort of 27.70, even back down to this low here, sort of 27.20. Below there, I'd be getting a little bit nervous, but for the time being, as I say, looking to buy dips. The same applies to the Dow. The Dow, it came back and off its high, it's retested the 23.6% FIBO level of the whole rally. Actually, the same can be said of the S&P and the 4-hour charts. We came beautifully tested the 23.6% before we started to squeeze higher again, and that kind of gives me confidence that we will test this 61.8. So going back to the Dow, I think right now we're sitting actually just below the 50% pivot of the whole move down. But I do think these dailies are fairly neutral at the moment, as I say, so we could see some more choppy trade. But the weeklies are turning to look a little bit higher. So from that point of view, I do like the upside. We close right on the 200-week moving average, so it could be a little bit choppy early in the week, and we may not see an awful lot until of direction until the Fed announcements on Wednesday and the GDP numbers are released at that stage as well. One interesting thing to look for in the Dow. This chart here shows the fall and the rising wedge that we're currently trading in. And like I say, it looks as though it could go higher. Now it does need to hold this support though, because as you will see here, this is the Dow. This is the 1929 to 1930 move in the Dow. We had this huge fall. We're in the rising wedge. It then broke on the downside and it went from there, and it basically fell by 50%. So we really need to keep a close eye on the base of the wedge here. Let me see if I can get that back again. So right now, it looks to me as though we can continue higher. But as soon as we see a break of this, I'd be a little bit wary. Anyway, back to reality and back to today. So here we have the Dow. As I say, the weeklies do still point higher. So I kind of think we might break above here, and on the top side, if we can get above this 50% and above the high 24,300, then we can possibly head back to sort of 25,000. That remains to be seen, but once again, I prefer buying on dips. Turning to gold, this is a 4-hour chart, and we do seem to be kind of rapidly running out of steam in the short term here. So the trend is obviously up, and we need to hold this sort of between 1690 and wherever this level is here, sort of 1675. As long as we hold that, I prefer to look to buy dips, looking for a move back up to this peak here, sort of 1746, which in itself was a long-term high. We need to go out to the weeklies. Sorry, this chart's a little bit messy. Let me just clear that up. Okay, so this was a high going back to 2012. Now, if we can take out this 1746 area, you can see there's not an awful lot to stop us heading swiftly to 1796, and beyond there, we're looking at the possibility of a run back to 1920. Now, the weeklies do look positive, and the monthlies also look positive. So I kind of like the idea of buying dips. The dailies are overbought, so I wouldn't be rushing in here. But if you can see it somewhere back down towards that 1690, 1670 area, I would certainly be looking to buy dips and probably have a stop loss placed below this low here, which is 1660. So that's for gold. Oil, who knows? Oil's too hard, really. But it's hard to see any real upside as long as we all remain in lockdown. Oil inventories are just going to build and build and build. So from that perspective, I think I'd prefer to be on the short side, but realistically, I think there's probably better things to look at. I'll quickly go on to the currency. Now this is a daily euro chart. As you can see, it's been pretty volatile, but not been an easy trade, really. I do think the euro is probably in a bit of trouble, but I can see it going back to retest these lows down here. But beyond that, I'm not really sure, because the US has obviously got major issues of its own. So I'd probably leave that alone. The currency that I kind of like at the moment is the Aussie, which the dailies seem to be pointing higher. We managed to close above the 55-day moving average at the end of the week. So the dailies look mildly positive, but the weeklies also look as though they're wanting to turn a bit higher. So I'm kind of hoping that maybe we can head back up towards, well, these lows here, I suppose, it's sort of 66.5. That's still a long way off at the moment. It's 2.5 big figures away. So there's a lot of work to be done before then. But I think the Aussie does look slightly positive. It's probably a better trade actually on the crosses, if we're just going to have a look at those. Right, here's an Aussie yen cross. Now I kind of like, the charts aren't showing us an awful lot, but I've been watching this head and shoulders. Let me blow that up a bit. I've been watching this head and shoulders for a few weeks now. Now, as long as we don't go back under this, or well, I suppose under this level here, 67.30, as long as we don't go under there, I prefer to buy dips, because the potential upside for this cross takes us back really to about 74. So you know you've got a big figure, and a bit stop loss, 1.5 big figures stop loss, and maybe sort of 3 to 4 big figures on the top side, something like that. So I think that's worth keeping an eye on. The other reason I like Aussie yen is because if you look at the Ichimoku chart, we've now broken back above the daily cloud, which we haven't been above there since early January, which seems an awful long time ago these days. But so we're back above the cloud, we're above the Tankan, and on the weeklies we're also back above the Tankan and the Kujin. So I kind of like the momentum to take us a little bit higher. If we can take out this 69 level, then there's possibly not an awful lot of resistance ahead of sort of 70, 71.5, and possibly even towards the base of the weekly cloud, which is at 73.5. Aussie Kiwi too, I think that's heading higher. It looks, that's a daily chart. We are up against some decent resistance here, but if we can take that out, that's right ahead at sort of this 106 2040 level. If we can take that out, I think we're maybe heading back up to here, this 109. Australia and New Zealand both coming out of this coronavirus thing. I think we've pretty much dodged a bullet, both Australia and New Zealand. But I just think the cross looks as though it might have some legs to move higher. Euro Aussie, where if I can find Euro Aussie, that looks very heavy to me. The dailies are pointing downwards, the weeklies are pointing downwards, the monthlies are not doing a great deal. But really, I think selling rallies on this cross here, you're probably not going to see much of a rally, to be honest. But I certainly prefer to be short rather than long. And I guess if you do, you put a stop loss sort of somewhere above here, but somewhere about 170, 170, 171 perhaps. Put a stop loss there. So that's about it as far as trading ideas concerned this week. I'll try and do another video next Monday, and we'll take it from there. The world could be a very different place by then. Until then, have a good one, and talk to you soon. Cheers.